Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
This week, we are coming out with 4 interesting webinars. The first webinar is Save Your Progress, where we will be discussing on how to protect your investment in tough market time and how to progress through it. And the second webinar will be hosted in Tamil language, where we will be discussing on on what time frame your investment need to be evaluated. And the third webinar is Gold, a shining opportunity, where we will be deep diving into the risk and reward involved in the asset class gold. And the fourth webinar is the top 7 risks need to be avoided in a bull market. If you are interested in any of these 4 webinars, you can click the link below in the description to register.
The market has been a very rewarding place for investors in the last few years. So, in this context, it becomes easy for us to slip up and make some common mistakes in our portfolio construction. We are going to talk about 3 mistakes that we can avoid making in today's market context. The first one is about anchoring to the wrong return expectations. If you've been blessed with very good returns in the last 3 to 4 years, and this is true of most mutual fund as well as equity investors, there is a need to look at our portfolios and see what is a normal return expectation. If you have made, say, 25% plus as compounded returns, the question is, can you actually sustain this kind of return in the next phase of the market cycle? We need to understand that the market returns are lumpy, which means you will have very good years which make up for the bad years that may come in the future. So, anchoring our return expectations to a more normal number makes sense at this point. The second mistake that we often see is position sizing. So, investors tend not to rebalance their portfolios. So, performers tend to occupy more space in the portfolio, and the newer ideas that can generate wealth in the next cycle tend to have a lower allocation. Moreover, in the context where there is more risk in equity markets, investors have a need to look at multi-asset opportunities, and usually the position sizing in these new ideas or multi-asset ideas tends to be lower. So, position sizing really matters, and this is why reviewing your portfolio and rebalancing it is very important at this juncture. The third mistake is that many of us are not self-conscious, which means that our investments are not actually aligned to our real risk appetites as well as our financial goals. One way to avoid this is to have a financial plan in place and to be clear about how much risk you want to take towards each of your investments based on your financial goals. If this video was helpful in terms of helping you reflect, then let us know in the comments below.